Hey everybody, good to be here today. My name is Brent Moore. It's time for Advanced Option Strategies. And, I'm just glad you're here. We're going to be talking about synthetics today. That's kind of where I want to head on this one. Do you know what a synthetic is? Well, I'm going to tell you what it is. I'm going to talk about pros and cons and why it may or may not be appropriate for your portfolio. But we'll go through example trades on that. And let me just mention this. I'm joined by Barb Armstrong in the chat. I know most of you out there know Barb, and she's wonderful. And so she's very helpful. And between her and myself, we'll do our best to get your questions answered in the chat as well. Also, just remember, Barb does have a trading a smaller account class that she teaches on Fridays, in fact, at noon Eastern time, I believe. And so there you go. You can follow either of us on X, at Brent Moore CS, at Barb Armstrong CS, for additional content throughout the week. Some familiar names in the chat. Glad to have you there. And if you're first time, glad to have you as well. Hey, options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only. It's not an individual recommendation of any security, chart pattern, or investment strategy. The Paper Money software application is provided for educational purposes only. It's not a recommendation. For the sake of simplicity, we may not factor in commissions and fees in these trades that we do, these example trades that we do, but just realize they are a real thing to take into consideration. All investing involves risk, including the potential loss of principal. And let's see, short options can be assigned at any time up to expiration, any time up to expiration, regardless of how far in the money or out of the money it is. So that doesn't happen in paper money. That's one of the differences between paper money and real money. There's no guarantee of an execution of a stop order that it's going to be at or near the stop price. Okay, so let's do this. Let me go over, we'll take a quick look at the market. This is the S&P 500. I have a 20 and a 50-day moving average. And, when you're trading, you always have a choice, right? There's a lot of different option strategies out there you can choose. And I want to start with just talking about a long call. Now, this is an advanced options class, so it's, we normally don't talk about long calls in this webcast here. But I want to talk to you about a long call and how it is like or unlike buying a stock. All right? And because there are some similarities and there's differences. And this may not be an exhaustive list, but I think it's a good start here, okay? So you benefit if stock goes up, okay? That's it on both long calls and long stock. You benefit if the stock goes up generally, okay? And you lose if the stock goes down, okay? So that's kind of the main thing I want to point out with the long call. And sometimes long calls are appropriate and sometimes they're not appropriate. One reason why some traders like long calls is they're leveraged. Okay, they're leveraged trades. And now leverage can work for you or it can work against you. If the stock goes down, that leverage is going to work against you. If it goes up, then the leverage is probably going to work for you. But that's how a long call differs from stock. The delta is lower. I guess theoretically you could buy 1 delta on a long call, but typically it's going to be, you're going to have a lower delta on the long call as versus a stock. Another difference is on a long call, you have negative theta. Okay, so that's kind of a bummer for most people. Time decay is working against you. That's what theta is. It measures how time decay affects the option. Well, stocks don't have any time decay on them. Okay. Another is you have positive vega. and on a long call. Now that can be pro or con, that can be good or bad. It just tells you how implied volatility affects the trade. Implied volatility changes don't directly affect stock trades, but they do affect long calls. Options expire, long calls expire. And that's a difference between a stock and a long call. You don't have to worry about expiration dates with stocks. And you know what? There's no dividends. Okay. So if you buy a call on a stock that has if you buy a call on a stock that pays a dividend, you're not getting the dividend. Option buyers don't benefit from dividends. Okay. Now let's talk about, I want to talk about a synthetic, okay? I want to talk about a synthetic here and what ways it kind of blends the two, is kind of maybe an intermediate in a sense between the two. So a synthetic, like a stock, it benefits if the stock goes up. Okay? And we'll get into exactly what a synthetic is, but when we talk about synthetics, well, think about in real life. A synthetic substance is something that is that is kind of imitative of the real thing. When we talk about a synthetic, a long stock synthetic trade, buying a call, selling a put, same strikes typically, that's what we're talking about as synthetic. Okay. It benefits like a stock if the stock goes down. It loses. It's like a stock in that it's going to lose if the stock goes down. Okay. So in that sense, synthetics are the same. It's leveraged like a long call. Okay. It's leveraged. The amount of money you're putting in is less than you put in for the particular stock, but you get the same movement. Delta, is the delta lower? No, the delta is going to be approximately, it may not be exactly 100, but the delta is going to be pretty much close to 100. So it's going to be very similar to being like a stock in that regard. Okay. Negative theta. No, a synthetic is probably going to have a theta that is pretty much close to zero. It's probably not going to be exactly zero. Same thing with Vega. It's probably not going to be exactly zero, but it's going to mostly cancel each other out. So in that regard, those areas where it's unlike a stock are different versus when we talk about a synthetic versus just a long call. Okay. And does it expire? Yes, it expires. So in that regard, it is unlike a stock. And if you own the synthetic, do you get a dividend? No, you don't get a dividend. In that way, it's unlike a stock in that regard there. So that's kind of stocks, long calls, synthetics. Why would someone trade a synthetic? Well, they want to benefit if the stock goes up. Obviously, they don't want to lose if the stock goes down, but they want to benefit if the stock goes up. Obviously, you're not going to do this unless you have a bullish forecast for the stock. But you want to leverage yourself a little bit more. And that's a reason why to do that. You know, if you think about a stock that's trading for, say, $100 a share, if you buy 100 shares of that stock, it's going to cost you $10,000. To get that same delta with a synthetic, it's going to cost you probably a fraction of that price. Now, we'll see. Let's look at examples here. Okay, so let's just pocket that for a sec. Let's go over here and let's talk about trading stocks, because the basic parameters you're going to use when you are trading, looking for a synthetic, are basically going to be similar to what you're doing when you're trying to buy stock, because you want it to go up. So from a technical analysis standpoint, usually what that means is we're going to look for things like, you probably could guess, trend. Okay. Now, technical analysis is not the only way to do a stock analysis. Okay. Well, let's get that out there right away. But very commonly, if you are using technical analysis, you're going to look for things like trend. You're going to look for things like support and resistance. I'm just going to abbreviate S&R there as a kind of a key thing that a lot of stock traders do. Uh, maybe we'll say price action. Maybe the stock is this, what's the momentum of the stock? Is it bouncing up? That kind of stuff. That is from a technical standpoint, which is what we're going to deal with today, is what you're probably going to consider if you're considering a synthetic. Okay, just like you would with the stock. Now, what about fundamental analysis? Could you use fundamental analysis? Absolutely. Let me make a generalization here. Generally speaking, the longer term you're looking, probably the more fundamental analysis comes in play. When you're looking at shorter term trades, probably the less the fundamental analysis comes in play. With synthetics, yes, you have an expiration date. Now, that expiration date may be 2 or 3 years away. It may be a leaps, but you can choose your expiration date. But there is an expiration date. But the longer term you go, the more likely you're going to incorporate fundamental analysis. Now, I'm not going to delve too much into that, but what do I mean by fundamental analysis? Well, maybe it's things like earnings growth rates. Okay, would that be a thing? Sales growth rates, margins. Do you want a good gross margin or operating margin or net margin? Yeah, you probably would like to see that possibly even improving if you're going into the fundamental analysis realm on that. Do some traders look at analyst reports? Some do. Yeah, some do. Do some traders look at valuations, such as PE ratios or PEG ratios? Yes, those are all parts of fundamental analysis. I'm not going to get into the fundamental analysis today, but just what I would say is this. If you are a stock trader and you normally look at fundamental analysis and you're considering a synthetic, you're probably going to consider at least fundamental analysis for that stock trade. But for our purposes today, I'm going to look at things kind of like this, our technical analysis there. So let's just take kind of an example here. And I'm going to start with a company that has had really some tough times, but maybe, just maybe, I don't know, maybe it's turning it around a little bit. This is United Health Group, and this has just had a rough time. I mean, it was up at over $600 in April. We dipped down all the way to $234. What's the trend right now, though? Well, the trend seems to be turned around. I mean, we're above that 20-day moving average. We have higher highs. We have higher lows on this right now. Potential resistance, I would have said, would be kind of like in this area. This was probably a pretty significant area there for this stock. We bounced off it there and there and there and there, and we broke through that. So that's potential resistance, perhaps a new support level. Okay. So is this a stock you would a company you would consider buying the stock on? Maybe, maybe not. But if the answer is yes, one possibility is to consider a synthetic. So let's do this. Now, if I buy the stock, let's say I bought 100 shares of stock. How much is that going to cost me? Well, $355. That's $35,000 approximately, $35,000 for 100 shares of UNH stock. Okay. And now, the dividend, there's a dividend. They pay a dividend. I don't remember exactly what it is. It's about 2.5% dividend. So by going with the synthetic, you'd be foregoing that. When you're doing a synthetic, it's an option, so you got to decide when your expiration date is going to be. You can go way out, 826 days out if you want. You can go shorter term if you want. I mean, you can go very short term if you want, but normally I'm going to consider this to be more of a stock trade. I'm looking for that trend. Let's go out to December and just take a look here. So here's December contracts. And like I said, we're going to look to buy a call and sell a put. Now, when we do so, it may be a little bit of a debit. It may be a little bit of a credit. Doesn't matter. Usually we're going to go at the money, and right now the stock's about 355, so it's kind of right in between those. If I go to the 350 strike, and I look to buy the call, and I go to the 355 strike. I'm going to hold down my control key and click on the bid price. I'm buying the call, I'm selling the put. Okay. What's my debit here? My debit is 533, or it's moving, okay, around a little over $500 for that. Okay. Now, that's not necessarily the buying power effect. The margin requirement may be different, but as opposed to $35,000 for the 100 delta, or close to the 100 delta, we'll see exactly what that is in a sec. Here, it's about $550 for that. So let's take a look here. Let me analyze this trade. Okay. Analyze trade. And I'm actually going to do something here. I'm going to go to add simulated trades. I'm just going to add the stock in. Okay. Let's uncheck that synthetic. Let's go to that risk profile. This is what the risk profile looks like for the stock right there. You can just kind of graphically. The more the stock goes down, the worse it gets, okay? You lose more money. The more the stock goes up, the more money you make. That's intuitive. You don't need to even think about that probably with stock ownership. Let's compare that to what the synthetic looks like. Here's what it looks like for the synthetic. Looks pretty much the same, doesn't it? Well, let's look at our we'll just look at the money here as to what we're talking about. 100 delta, well, pretty close, 99.6 delta. So like 100 shares of stock in that regard. Our gamma, very little. It's showing about $1 theta. That's not huge, but there's a little bit of theta, but a lot of traders would say that's pretty insignificant. Why is that? Because look, you've got a 350 long call, which is negative theta, but you've got a 350 short put, which is positive theta. Time decay helps that put out. That's why they largely offset each other. And so your theta and your vega are going to be very low levels there, very low numbers on that. Okay. That's a synthetic. Now, that's entering the synthetic. Remember, we're entering if it'd be very similar to as if we're buying the stock, okay? Your entry rules. What about exiting? Well, your exiting rules are probably going to be pretty similar if you're buying the stock. If my assumption is this is going to trend up, then as long as it's trending up, maybe you stick with it. I don't know. I mean, at some point we'd hit an expiration date, but that's a ways off. Furthermore, I may set a stop loss. Well, to start, I'm going to put my stop loss just a little bit under my 20-day moving average, below where my old resistance was, where my new support level is. That was around 317. Let's go down to about, 310 maybe, and put a stop in there, okay? So here's how we're going to do this. Technically, it's not going to be a stop. It's just going to be a rules order to get out of this thing. But I'm going to change this from single order to first trigger sequential. I'm going to right click on this. I'm just going to create an opposite order. And this is an order to get me out. The 350 call that we were buying is now we have an order to get out of that 350 call. The 350 put we were selling, well, we have an order to buy back that 350 put. That would get us out here. This is going to be a market order, good till canceled. And I'm going to click on my gear, and it brings up this window. And we said, hold on one sec, because I already forgot. We said if we were breaking down below here, around 310 is what we said. I should have written that down. Around 310. So I'm going to look to get out of this if it goes below 310. I'm going to click on that gear. Just see if I can shrink this a little bit so you can see it a little bit better. Right there, right in the middle. And we're going to scroll this. I'm going to look right down here. If UNH marks less than or equal to 310, that's going to get us out. We're going to click on save. We're going to click on confirm and send. I'm just doing one contract. What's the buying power effect? Well, let's take a look. It's the better part of $10,000. So just because it's not costing us as much, right? It's only costing us, less than $600 for this thing. It doesn't mean that it doesn't affect our buying power more than that. How much could we lose? Well, you could go, well, look, that max loss is very significant. Well, that's true, as if you bought the stock too. If you bought the stock and the stock went to zero, you'd be losing a lot of money, okay? You'd be losing a lot of money. Presumably this isn't going to go to zero, but I can't guarantee it. I don't know. And don't get too excited when you say infinite on the max gain. That is a matter of, just like a stock. You buy a stock, the stock theoretically has an infinite gain, but that's, you're not going to be have infinite net worth after that. Anyway, okay, so let's go and now there's a good question in the chat. Mighty Mouse says, what's the potential loss based on the stock price? That's very appropriate, because that's a good question. This is the max loss if the stock goes down to zero. What if it goes down to that 310 mark, which we see right there? What's our loss going to be? Well, we're going to lose, basically our delta is $1, okay? Our delta is 1. So every dollar down from where the stock currently is about 355. That's about $45 down there. So that'd be about $4,500 if we were to get stopped out on this. So when I talk about leverage and you say, hey, it's only costed me $588, Brent, that's awesome. Well, that's great. But if the stock goes down, look to our stop, that $588 initial investment is now, you're losing $4,500. Okay. So there you go. That's that. Any further questions? Any further questions on that? Let me know. So this was a long call and a short put. Just a short put, not a short put vertical. Okay, just a short put. That's our synthetic. Typically, we're going to do those at the money. Same strike on those. Okay, same strike, same expiration. Now, so what I'm going to do here is, after you've read that and you go, oh, that looks fine, then what I'm going to do is I'm going to click send and buy. Now, I kind of gave you the bad leverage scenario of the stock goes down and hits kind of what we're calling our stop, that rules-based order to get out at 310, how that leverage works against you. But the leverage works for you too, okay? So what if the stock goes up, I don't know, let's say up to this gap here, 483, okay? So maybe that's too overly optimistic. Let's just say it goes up to $400, okay? Not a super massive run up, goes up to $400. The difference between $400 and $355 is about $45, and that is that'd be about a $4,500 gain there on a pretty, what was that, a $500 and I don't remember, $60, $70 initial investment on that. There's leverage working for you on that. So it can work both ways. It can work both ways on that, okay? So now, good question from Planderson, okay? Question is, do you manage as a set or do you ever close one leg? Okay, so kind of our standard approach here is going to be manage as a set, because the long call and the short put together make the long synthetic. And if we get out of one leg it's we're not getting out of the synthetic. We're getting out of part of, well, we're out of the synthetic, but we're left with either just a plain old short put or just a long call. Well, maybe you want to do that, but that is changing the trade. It is changing the nature of the trade. Remember when we looked at the initial kind of attributes of the trade and we said, let's say we just left it, we got out of the short put and we were just left with a long call. Well, we still have a bullish trade. Our delta is going to go down. Okay, it's going to be a lower delta. And it's going to be time decay. Our theta is going to be negative in a significant way. I know we're a little negative right now, but it'll be much greater negative theta in that case if we just get out of the short put. We're introducing Vega implications on it as well. So I would say in general, you're going to manage it as a whole, but certainly if you know what you're doing and you have an intention about it, you certainly could get out of one leg or the other. Okay? All right. So Vic said synthetic stock. Yeah, this is synthetic stock. That's what we just did. That's what this trade is. It's synthetic stock. All right? So yeah, good. Barb said good questions, everybody. I agree. Very good questions. Okay, let's see how we're doing. 326. Let's look at another example here, okay? I'll probably go through a little quicker on this example here, but let's go to Citigroup. Okay, remember the kind of the three things that I mentioned in terms of technical analysis. Trend, what's our trend? Well, I'd call that an upward trend. Support and resistance. Well, I'd say we probably had some resistance kind of in this area. We just broke through though. And momentum, well, momentum or price action has been going up. In fact, we're at a high right now, a 6-month high at least. I don't know if that's an all-time high or not, but it's nice upward momentum there. So in terms of the kind of those check boxes that a lot of technical traders look at, that's what they do. How long do you want to do this for? Could you do let's say you're long-term bullish on Citigroup, okay? You think, well, with lowering interest rates and now there's no guarantee they're going to go lower, but and a steepening yield curve, perhaps, you think financial companies, banks are going to benefit, and that's going to last for years. Could you go out for a longer term trade? Yeah, you could. Keep in mind what you give up in terms of dividend. Let's see what we got. Again, about a 2.5% dividend on that. So, and those dividends can make a difference over time. So this is a more aggressive trade than just buying the stock. It's going to take a portion of your portfolio that's a more aggressive portion of your portfolio. It's not stock. We call it synthetic stock. It's not stock. Look, I can go out to June of 2027, 643 days. Long-term forecast. I can go here and our stock is right around $100. Let's go to that $100. Okay, I'm going to click on the ask price. I'm going to click on the bid price, holding down the control key. Here's my long synthetic. Doesn't expire until June of 2027. If I click on, well, how much it's costing me? It's costing me $188 plus commissions, okay? $188. Well, how much would 100 shares of stock cost? Well, 100 shares of stock of $100 stock would be about $10,000, okay? If I just did a Leaps call, it cost me about $1,500, okay? About $1,500 on the Leaps call. The price of the put that we're selling is going to offset that a lot, okay? Let's go here and let's talk about when would we get out of this. So that's our entry. If we want, we could do this. We could go, let's analyze this and just kind of, I'm going to go a little quicker on this just because we already went through it. Delta, close to 100. Theta Vega, very small numbers there on that. So we'll see. And notice if the stock goes up significantly, in this case 10%, or down significantly, down 10%, the delta is staying pretty constant. And that's going to be true. Even if I change that and made that up 30% or down 30%, yeah, the delta may change a little bit, but we're going to stay more or less in that 100 range, which is different than if I do a long call. Because if I just do a long call, I have more significant gamma in there, meaning that stock is going to move, the delta is going to change more in that circumstance. All right. So there we go. That's that. When are we going to get out? Let's look. We could put a stop in. Again, I'll probably put a stop below my support level, but this is longer term. Maybe you go even lower. Maybe I go below my 50-day moving average and give it a little buffer. Let's go maybe 3% below the 50-day moving average. That's going to put my stop right around $90. Okay? $90 stop. Could you put in a target price? You could put in a target price. On this particular trade, though, this is a long-term trade. Typically on long-term, I don't want to use the term buy and hold because that's kind of a loaded term and it implies things that I don't intend here on this, because buy and hold just indicates that we're going to hold no matter what. We're not. But typically on these longer-term bullish stock trades, we're not just going to say, hey, if it hits 105, I'm going to get out of this trade. On a swing trade, you could, no doubt. You could, but in this case, so that's my stop, and that's what I'm doing. Okay, so now that R1 asks a question that's pertinent here. Okay, so because my delta is 1, and it's going to be fairly consistently 1, and we said our stop was going to be, I was going to put in the stop around 90. If I wanted to make it kind of a reward to risk ratio of 2 to 1, and you can't do this with most option trades, but because my delta is about 1 and fairly consistently 1, doesn't matter whether the stock goes up or down a little bit, then all I would need to do is take the difference between the current price, which is, we'll say $99, down to 90, that's a $9 difference there. If I want a 2 to 1 ratio, I would make that 18, and I could put an exit order up at $18 above where the current price is, or about roughly $117. That would be your target if you were to place one. We're not going to right now, but that's how you could do that. And our stop, we said, was going to be around 90. Okay, stop was going to be around 90. So hoping is that making sense? R1, just answer if I need to explain anything further on there. Yeah, and let me add in something. And Barb already answered this in the chat, but I think it's, for those of you who aren't watching live and don't see the chat, I think it's an important question. Thank you for bringing it up, Greg, by the way. If you don't want to use a stop, because remember, stops aren't guaranteed. I mean, whether I'm doing a traditional stop or this kind of rules-based conditional stop, then either way, we're not guaranteed to get out wherever I can say I want to get out if it's at 90 or less. Well, what if the stock goes down to $70 overnight or something? Probably unlikely, but theoretically it could happen. Where am I getting out? I'm not getting out at 90 in that case, probably getting out close to 70. So, so some people, have concerns about that. And could you put in a long put yeah. So if we're going to buy, look, we're looking to buy, I'm just going to put plus to indicate buy, $100 call, and we're selling a $100 put. Could I then say buy an $85 put? Yeah, I could. The $85 put's going to be cheaper because it's a lower strike. And in fact, if you want, you don't even have to go out as far on this. as a means of trying to help protect the portfolio. Yes, absolutely, you could do that. Okay, so let's go, and here's the trade right there. Market good till canceled. Click on the gear. Scroll down. Go down to Citigroup. Marks less than or equal to. We said 90 bucks. $90 there. And save and confirm and send. Make sure you read it. It calls it a combo. Okay, we're buying the call, put, initial cost of trade, including commissions. Well, and this is paper money, right? About 200 bucks. Okay. Max loss, about 10,000 bucks. That'd be if Citigroup goes to zero. There's not that much time decay, so even if it doesn't go down, so even if it kind of goes down a little bit or goes sideways, we're not really going to be, well, put it this way. If it goes sideways, we're not going to have much time decay, degradation of the trade there. But there is that expiration date. We are also missing out on those dividends, as I mentioned. Max profit, well, it's unlimited. As long as the higher Citigroup goes up, the better I'm at in that case. Okay, so I'm going to click on send, and I'm going to send that order there. Okay, so there we go. Now, there's one other thing I want to talk about today. Okay, so that's called a long synthetic, folks. Let me just kind of summarize the long synthetic. Then I want to look at a trade that we did last week to wrap up. And if you have any questions, right now is a great time for those questions on that, regarding that synthetic. But what's a synthetic? It's meant to kind of mimic the trade of a stock. It's not exactly the same thing. It expires, you don't get the dividend. It's leveraged. Leverage can work for you or against you, but for a more aggressive place in your portfolio, maybe it makes sense. Now, the danger is people look at it and go, oh, this is like buying stock, but cheaper. Okay. And so they just go, well, I'm just going to load up my whole portfolio with synthetics. Just be careful on that. Remember, there is a buying power effect that's greater than what the cost of the trade is. So that will limit you to a certain extent, but make sure it fits in your portfolio. Most people have more conservative portions of their portfolio and maybe more aggressive portions of the portfolio. This may be falling a little bit more in the more aggressive portion of there. And so Ray said, can we buy a put as protection? Yes, I just mentioned that. That was Greg's question there, Ray. And we said we could buy a put as protection on that if you wanted to. Okay, that's no problem at all. Now, let's go and talk about, last week, we talked about straddle strangle swaps. And we did one on Adobe. Okay. And this one was intentionally on earnings. And let me just kind of zoom in time frame here on this and look at what happened with the earnings. Okay. This was yesterday going into close. Okay. So the stock going into close, and I was looking at this yesterday, the post trading. Immediately it jumps way up. Okay. Now part of the synthetic is we have a short straddle on this. Well, short straddle, you don't want the stock to move much. Well, what are we seeing? We're seeing it was a significant move. Okay. It may not have been the market maker move initially or anything, but it was a significant move. But then it just kind of immediately tamped down, and then it still looked up. And then what happened? We open up today. I don't know exactly where we opened, but right now we're right here, which is basically the same price we had before the earnings. So in the case of our straddle strangle swap, it actually turned out really well. Okay. And in fact, if you go to Adobe, you can see we've actually done quite a bit. And when we talked about managing this, last week, one of the things we mentioned was if you've made like 30% of what max gain, then we're looking to exit out. So in this case, I'm just going to probably get out of that. Okay. I'm just going to get out of that trade right now. Now, when you're getting out of a 4-leg trade, very often it's hard to get out of all 4 legs at once. It's easier to get out of, kind of break it down. So you can create a closing order. And I'm just going to get out of the straddle portion of that. And let me just do that. Okay. Now we're out of the straddle portion of it. And then we can get out of the strangle portion of it. I can create a closing order. I'm going to sell that, move it off the mid just a little bit to make sure we get a fill, send that, and we're out of that trade there. And we've taken a profit. Now, if we wanted and we waited a little bit longer, it's possible we could have made more, but we made what our goal was to make on that. Hence we're getting out on that. Okay. So that's what we got today, folks. I'm so glad you joined us. This was long synthetics. You know, you can do short synthetics too. We'll cover that in a different session here. I don't have enough time to go into that today. But I'd encourage you all to subscribe to the Trader Talks channel. That way you don't miss content. Also, you know what? If you click the like on the video, we appreciate it. It helps promote our channel, helps promote the cause of free education. Those are a couple big things. It also helps boost us as instructors, makes us feel good too if you do that. But thank you very much for joining us today. I appreciate you all. Thanks, Barb, for helping me on the chat. And we will see you all same time next week. Bye-bye, everybody.